All right, guys. Today will be on the new standard called employee benefits. It's IAS 19, right? IAS 19 speaks of employee benefits. By employee benefits, they are all forms of consideration an employee is entitled to when working with a certain company, a certain institution, right? So that's what is called employee benefits. Now, how do we account for that in the books in our financial statements? That's the question here, just how we account for that. Now, there are some of the benefits that are usually very obvious that we do not even need to have a standard. For example, salaries. Salaries are one form of consideration, and we all know that salaries are usually expense in the statement of profit or loss, right? Without any problem. But actually, there are other benefits like pensions, which actually require a complex consideration, and so the standard comes into play. All right. So we'll actually see this. As you see, there are several forms of consideration and maybe how to account for that. All right. So actually, we have the following types of employee benefits. Some of them are very obvious, and some maybe you need to take a deeper look into. So as 19 employee benefits identifies four types of employee benefits, which are as follows. Post-employment benefits. After employment, there are benefits that you are entitled to, and most of time they are retirement benefits, right? After employment, maybe you will have some funds that will be given so that you can proceed with your life. But also, we can have short-term employee benefits. Examples of short-term employee benefits are like these salaries, right? When you are actually in employment, for example, wages, salaries, maybe you can have bonus and other benefits. So these are short-term employee benefits, which are normally not post-employment, right? But also we can have termination benefits. Termination benefits, as you see here, termination, they speak for itself, right? The benefit that you obtain upon termination of the, let's say, of the contract of the employment. Termination benefits arise when benefits become payable upon employment being terminated. It's either employment has been terminated, either it depends on how it has been terminated. Maybe the employer has terminated it, or by the employee accepting terms to have employment terminated. So you can have both options, right? Yes. But also, you can have this last point here of other long-term employee benefits. So you can have other long-term employee benefits other than the above, right? For example, maybe this comprises other forms not within the above classifications and will include maybe a long service leave. Let's say you have a leave for a long service for a long time, or maybe awards, maybe long-term disability benefits. You're working with a certain company, maybe you got injured, and so they have to compensate you, and other long-term service benefits. So these are just some of the examples that we can take a look into and see how to proceed, right? Okay, now each will be considered within this chapter, and we'll see how to account for everything. Okay, let's start with the post-employment benefits. This one is the most important point, and actually in the exam, it's something that is usually asked. That's why they decided to start with this, right? Post-employment benefit plans. Now, what is this? Most of the time we call the pension plan. It's the pension plan actually after employment, maybe. When working, you usually have the employment plan, right? The pension plan, and then after employment, maybe they have to give you that money. So the pension plan, sometimes called the post-employment benefit plan or scheme, consists of a pool of assets together with a liability for pensions owed. Maybe let me speak this in a very simple manner, right? It's like this. Actually, when the money is taken, maybe you are registered to a pension plan. When your money is taken, when they deduct some of your money and take it somewhere, it means that that money can be used to buy some assets, right? But as an entity, so to buy some assets, and then actually someone will be obliged to pay you back with something. So actually, the pension plan will have assets and liabilities. We can call those assets. We can call those assets pension plan assets, but those liabilities for which they have to settle so as to compensate the employees, we can call them the pension liability, right? Or plan liability. So you can have the plan asset and the plan liability, something like that. The plan assets will be used Maybe they will be invested somewhere to obtain returns and be able to cover the the plan liability, right? Okay, so that's why we say pension plan assets normally consist of investment most of the time, right? In the pension, some the pension fund usually use those funds to invest maybe in security like in shares, in debt, something like that. So as to earn rate, so as to earn maybe interest, to earn dividends, something like that. It can be just cash or sometimes the properties. That's the situation. And the return earned on these assets is used to pay pensions. That's why we say that a pension plan would have separate assets and liabilities, and the assets will be used to generate income, but also to to settle the liabilities, which are what employees are entitled into, right? So we have two main types of pension plans. There are two main types of pension plans. One of them is called I'll just highlight the important points. Defined contribution plan, but also defined benefit plan. Now, something that is worth noting here, very, very, very important is the defined benefit plan. Let me just distinguish them, right? As for defined contribution plan is something very simple. What the main difference here comes that when you're told it's a defined contribution plan, it means that, right, it means that once you contribute something, that goes into those assets to buy those assets, you are not you are not obliged to pay anything to compensate anything. So once you pay something actually to have those planned assets, even if those planned assets fail to generate sufficient return to pay out the planned liabilities, you won't be obliged for anything. The liability ends there. The obligation ends just by contributing. While when speaking of the defined benefit plan, we mean that once you make a certain contribution, the liability doesn't end there. In case the plan assets are exceeded by the plan liabilities, you still have to compensate the employees. But in case maybe the plan assets exceed too much the plan liabilities, you can be given something called the contribution holiday. You can stop actually get paying out the contribution because they see that, oh, you paid much more and actually you have the reserve, so no need to pay. So simply speaking, defined contribution plan actually remove the risk, but defined benefit plan, the entity retains that risk. And actually, the way to account for that we'll see later. But for defined contribution plan, I think you can see it like right away. So defined contribution plans are benefit plans where an entity pays fixed contribution into the separate entity, right? So maybe you are an entity that wants to account for these contribution plans, so you pay them. Maybe there is a certain entity, maybe it's a pension fund company, it's a pension fund institution which receives such funds. That's why you say an entity pays a fixed contribution into a separate entity. And now have see this, and will have no legal or constructive obligation to pay further contributions if the fund does not hold sufficient assets to pay all employee benefits relating to their service. I hope you got this. I'm repeating again. By contributing, you will be piling up the plan assets, and then you will in turn be incurring plan liabilities, which are actually expected to be received by the employees. So if you contribute and maybe employees cannot be compensated enough, you will have no obligation as an entity. While as for defined benefit plan, these are post-employment plans that are not defined contribution. Simply speaking, if something is not a defined contribution, that means defined contribution actually if you just pay once, you cannot have any other obligation. So in case you have any other obligation, that's what we call the defined benefit plan, right? Just like that. All right, maybe for example, here they say, look at this is just an illustration, right? Let's say an entity pays fixed contribution of 5% of employee salaries into the pension plan each month, right? The entity has no obligation outside of its fixed contributions. I think this is actually, for example, in Tanzania, we have this, right? You can be told maybe the entity pays a fixed percentage of the salary. And after that, actually, even when the employees cannot be compensated by the pension fund, They cannot go back to the entity and say, oh, I haven't been paid my pension fund because they said that there are no sufficient assets, so you have to compensate me. No, the entity is totally deprived of that obligation once it pays out that percent, right? Okay, that's why we say the lack of any obligation to contribute further assets into the fund means that this is a defined contribution plan. So just take a look on whether an entity still has an obligation or not. If the obligation is totally extinguished just after contributing, that's a defined contribution plan. Else, it's a defined pension plan. It's the defined benefit plan, sorry. All right, maybe another example here. And the example goes by, an entity guarantees a particular level of pension. Do you see this? An entity guarantees a particular level of pension benefits to the employees. By guaranteeing means that if maybe in case maybe employees had to receive 10 million, but there is only 80 million to give out, you have to give out that additional 2 million. And in case maybe you have given out 10 million, but employees need only 6 million, then we say, fine, just give them the 6 million, then that 4 million will be retained. All right. So that's what we usually do. This is just, it's not a rule that you have to do this. You actually read the question and see what to do, right? So the annual pension income that employees will receive is based on the following formula. All right, this is just an example, but usually it's something normal. You can just take a look at the question. For example, let's maybe take an example. Maybe salary at retirement. I hope you know this, right? To determine the pension, we usually use the salary, the last salary actually, when still working. So you can take that salary and then you can do whatever has to be done. This is just an example. So what we do know is that an entity has an obligation to pay extra funds into the pension plan to meet its promised level of pension benefits. So if the benefits are required are much higher than what has already been invested, then an entity has to make a compensation. And this is called a defined benefit plan. Okay, now let's take a look at this example here and see what we can do. Just understanding number one, the question goes by, Della has a defined contribution plan scheme, contribution pension scheme. Then, however, during the year, it introduced a new post-employment plan. The fund for its employees is a way of enhancing the benefits they receive when they retire. And then Della makes monthly contributions into the fund that are equal to a set percentage of the salary cost. Okay, no issue, contributions are made, no issue. Then you're told here that upon retirement, employees will receive annual payments from the fund based on the number of years of service and their final salary. Okay, no issue. Then further, we are told that the fund is voluntary and Della can cancel it at any point. Okay, so that fund is just voluntary. Della is not obliged to proceed with that, right? Della can just decide to cancel out that fund. And again, here we are told that Della has a history of paying employees benefits that are substantially above the national average, with the annual increases in excess of inflation. Della has won many accolades as a top employer and received positive coverage from the national press when the fund was announced. The leadership team are well trusted by the employees. So it seems that management is just fine, right? Now, what are we required to do? Advise Della on whether the fund is a defined benefit plan or a defined contribution plan. So a defined contribution plan is already in place, but maybe another thing has been actually introduced called the fund, and it has shown the following features, right? First, Della makes monthly contribution to the fund. That's no big deal. Upon retirement, employees will receive annual payment from the fund based on their number of years of service and their final salary. The fund is voluntary. The fund is voluntary, and Della can cancel. So Della can cancel it at any moment that it decides. But also, we are told that Della has a history of paying employees benefits that are substantial above the national average. So you see that, oh, so normally the Della pays employees above national average. Now let's go to number 1. It was just understanding number 1, right? Oh, it's not here, it's number 1. It has a lot of questions. Okay, now we can come and see here, right? We just need to make a distinction on whether that fund is a defined contribution or a defined benefit plan. So it is possible that there will be insufficient assets in the fund to pay the benefits due to retired employees because, as I told you, you just compare planned assets and those liabilities, right? So it may be possible, maybe the asset may be insufficient, that's fine, particularly if final salaries rise maybe due to what inflation, because we are told that there is some kind of inflation, right? So if it includes inflation, maybe the amount to be paid could have risen much more while assets could not be sufficient, right? But now you say that Della therefore bears actuarial and investment risk because if it continues with the fund, it would need to make up for any shortfall. But actually, if we proceed here, we find out that although the fund is voluntary, the point that the fund is voluntary could have led you to think that this is a defined contribution because it's just voluntary, you can cancel it at any time. But while you are at it, actually, it means that you have committed yourself, right? So although the fund is voluntary and can be cancelled, Della has a history of remunerating its employees above the national average. So you find out that, oh, actually it's still voluntary, but Della has that history of actually remunerating paying its employees above the national average, as well as the strong reputation as a good and honest employer. So accounting wise, you find out that, oh, actually Della is maybe ready to account for that. So Della therefore has a constructive obligation. I hope you know the difference between legal obligation and constructive obligation, right? So I actually say that, oh, Della, if Della find out difficulties, you say no, I cannot pay this. Let me just ignore this. But we find out that although not legally bound, for example, this is voluntary, so they can cancel. Although no legal obligation, still there is a constructive obligation because just by looking at the practice, at the common practice, at the general practice, uh, what that has raised a valid expectation to the community about Della, right? So they have a constructive obligation to continue the fund and they ensure that its level of asset is sufficient. So we find out that this should be a defined benefit plan. So that's just a way of taking a look at questions and making a decision. All right. Now let's proceed with the accounting for defined contribution plans. You know, defined contribution plans, I hope we went through something called lease. When we studied lease, we took a look on how to account for lease in the lesser side and for operating lease. The same way we apply it here. I'm repeating again. The way of accounting for lease in the books of the lesser for an operating lease is the same as what we do here. So simply speaking, the entity should charge the agreed pension contribution to profit or loss as an employment expense in each period, right? Just like that. There are several methods to use, but the common method is usually to use the straight line method. So we say here the expense of providing pensions in the period is often the same as the amount of contribution paid. Normally it's the same. Normally an expense should be the same of an amount paid, but maybe they could be different. Let's say you're paying 100,000, then the next time 150, the next time maybe 90,000. You have to take an average. So it could arise usually this expense should be exactly the same to the contribution that is paid, right? But it may be different. And so we say, however, an accrual or prepayment, if they do differ, you obviously have to include an accrual or what, or prepayment, an accrued expense or a prepaid expense. If the cash paid does not equal to the value of the contribution due for the period. Maybe let me do something like this. Let me make an illustration here. Defined contributions are obvious, are very obvious. Let me presume here that in the first year we had year one, we had year two, and then we had year three. Let me just write down these years. And maybe the pension contribution paid. The contribution that was paid was like this. In the first year, actually $100 million were paid. In the second year, 120. And then the third year, let's say it was how much? Kind of, maybe let me make it 50. It's just like this. Let me make it 50. Now, by doing this, we would say that to obtain in the income statement now, you have to record an expense, right? And what? An expense. Now, to record an expense, you may make matters very easy. To record an expense, actually, you may just do this. You may just take an average, right? Yeah, just take an average. How do you obtain that average? Average. Let's say it's what? Yes, expense average. Now, how do you obtain the average here? 100 plus 120 is 220, plus 50 is 270, right? So I would say 270 divided by 3 to obtain that average figure, right? Yes. Now, to obtain that average figure, how much would it be? 270 over 3, that would be 90, right? It's 90 here. And then the same, I'll have another 90 there, and then I'll have the same figure, which is 90. Now, having done this, you have to understand one thing. Remember, when you pay something, when you pay for something, maybe let's try to make the double entry for the first year. Let me write here year 1. Here you have year 1. When you paid 100, what was the double entry? It's obvious that when you pay 100, it only means that you credited cash, right? It only means that you credited cash. Credit cash, maybe bank, whatever. Let me just write cash of how much? Of 100, right? And then I would have to debit something. Maybe I would say debit. Let's presume that we just debited pension, right? Pension. Let's say it's a pension expense. Then I would say 100. But you have to know that here, it's not right to write the pension expense as 100 because the actual expense is 90, right? So this means that we have to adjust this pension. The pension should actually be 90. You find out that the pension is actually 90, but I've already paid for how much? I'm repeating again, the pension is 90. The expense is actually 90, but I already recorded 100. So what do I do? It means that I paid much more than what I should have paid. Because when you call something an expense, it's what you have really incurred during the period. So you say, oh, in reality, you could have paid just 90, but actually paid 100. So you paid more. So if you paid more, it is a prepayment. It's a prepaid expense. And we know that a prepaid expense is an asset. So I would say debit a prepayment or prepaid expense, prepayment or prepaid expense of how much? I prepaid something of 10, right? And then I would have to credit what? To credit that pension expense. Now, by crediting the pension expense by 10, we mean that initially I had recorded 100, but then I would have to reduce it by crediting it by 10. So 100 minus 10 would give rise to this 90, and so the entries will be fine. So that's why we said you have to record a prepayment here. So actually, the expense would end up being 90 because it would be this 100 minus 10, that would give you 90, and then you'd have your prepayment, right? So in an exam, you have to learn the double entries. You have to know what has been recorded already and what is yet to be recorded, so you make adjustments. For example, in the explanations here, they mean that this has already been accounted for, but this prepayment and pension expense of 10 is yet to be accounted for. So in an exam, you would have had to account for that one, right? Okay, then let's go to the second year. For the second year, now, for the second year, let's presume that this 120 had already been paid. So I would say debit 120 and then credit 120 cash. Then I'll just go directly and just make an adjustment for this. So I had to pay, I had only incurred 90, but I actually paid 120. What happens now? I have incurred 90, but I've paid 120. If this is the case, we say that, oh, I've paid 30 more. So in the second year, if you had paid 30 more, you would just say this way. You'd say, oh, so I've also paid something in advance. So I would have to debit the prepayment again, prepayment by 30, and then I would say, oh, now the expense which is currently written as 120 has to drop down to 90. So I would have to debit the pension, to credit the pension expense by the same figure, which is 30, right? Yes. So you have to do something like this. Actually, you could see, in case this prepayment maybe has not yet, for example, maybe you can just come and see the net prepayment because, the prepayment is an asset and in the financial position they usually accumulate. For example, you can find out that, oh, for the first and second year, I've paid a total of 100 plus 120, that is 220, but the expense incurred is also 90 plus 90, that is 180. So there is still an extra 40 prepayment. And that's why you find that I'll have a prepayment of 10, but I'll have another prepayment of 30, and this will give me a total prepayment of 40, right? Okay, now let's go for the third year. To the third year, I'll just go the same way. I would say, oh, I've incurred 90, but I've only paid 50. Again, I've incurred 90, but I've only paid 50. So that means that I still owe, that means that I still owe how much? I still owe 40. So that 40 is not a prepayment, it's an accrual. Or you could just say accrued expense of how much? An accrued expense of 40. Now, by having an accrued expense of 40, it means that I've already recognized the 50, but I actually have to recognize 90. So in the income statement, that expense would be much lower, and I would therefore have to increase that expense. I would have to boost up that expense. That is the pension what? Pension expense by how much? By that figure of 40. Actually, this is just a topic of accrual and prepayment, right? Or for F3 financial accounting. But you have to know that. So that's all about defined benefit plans. Maybe we should just proceed and see what is written down here. Here is another example. They say defined contribution scheme, and then an entity makes contributions to the pension fund of employees at the rate of 5% of gross salary. So to obtain the contribution, take 5% and the gross salary. And then for convenience, the entity pays 10,000 per month into the pension scheme, with any balance being paid in the first month of the following accounting year. All right, that's what they do. All right, so this is just for convenience that the entity pays 10,000 already per month into the pension scheme, with any balance being paid in the last month of the following accounting year. The wages and salaries for 2026 are 2.7 million. All right, we are told to calculate the pension expense for 2026 and the accrual or prepayment at the end of the year, right? How do you proceed with this? First of all, as you are told here that an entity makes contributions at the rate of 5%. So I would say 5% times the gross salary, so it would be 5% times 2.7 million, right? Now take 5% times 2.7 million, how much would it be? It would be 2.7 million times 5%, 13.5, it would be 135,000, right? So that one would be the contribution. The contributions are the actual cash paid. That would be that much, right? But also you're told that for convenience, the entity pays 10,000 per month into the pension scheme until any balance, into the pension scheme with any balance being paid in the first month of the following accounting year. So, all right, now this question is much clearer. We are told that 10,000 is paid per month. Now, for the entire year, it will be 10,000 times 12, right? And then 120 would have been paid by the end of the year. Let's go and take a look at this. Where is number 2, right? Yes, here. So this appears to be a defined contribution scheme because, as you see, there is no further obligation, there is no risk to the entity, so it's very obvious. All right, so the entity has to pay, actually has to pay 5% times 2.7 million, which gives you 135,000, right? But the question has specifically stated that the entity contributes 10,000 per month. So in a year, it would be 10,000 times 12, which would give us 120,000, right? So you find out that by the end of the year, 120 has already been paid, right? But actually, the actual expense was 135. We actually had to pay 135. So we say, oh, we still owe the difference, that is 15,000, which is an accrual. That's why we say we have an accrued expense of 15,000, and maybe that 15,000 again, I'll have to credit that means credit accrual by 15,000, and then I would have to debit the pension expense by 15,000 because remember, I would already have included 120. So by adding that 15, I would get a total of 135,000, right? Okay, so that's the defined benefit plan. Defined benefit plan, and so we need to go through the defined. So it's the defined contribution plan. I don't know why I'm putting this in a different manner. So next in line is the defined benefit plan, right? Defined benefit. Now I'll be speaking of the defined benefit plan. Now, as for defined benefit plan, as I told you, you would have the plan assets, but also the plan liability, right? Yes, you would have the plan assets, but also the plan liabilities. Now, under the defined benefit plan, an entity has an obligation. We spoke about this already, and therefore it has a long-term liability. So simply speaking, we will have the plan asset, but also the plan liability, right? And by proceeding, we say that on the statement of financial position, you would have the pension obligation, which you can call plan liability, and the plan assets, and report the net position. So first of all, in the statement of financial position, we do not report plan assets and plan liability separately. No, we combine them. If assets, if the obligation exceeds the asset, that means if the plan liability is greater than the plan asset, then the net is the plan deficit. So it would stay in the statement of financial position on the liability side, right? So a liability is reported in the statement of financial position. In case the plan assets are greater than the plan obligation, than the plan liability, we mean that there is a surplus, and so an asset is recorded and reported in the statement of financial position. That's one important point to note here. Okay. Now we say that it's difficult to calculate the size of the defined benefit pension obligation and plan assets, and therefore it is recommended that the entity use an expert known as an actuary. That's why you usually get gains at the end of the year called the actuarial gains. You'll see that, right? But actually in an exam, this is none of your business. Okay, so as you can see here, there are the year on year movement. Let's take a look at this, and then maybe later I'll explain it a bit more. And this is what we usually do, right? Here it's given in the form of net. You see there, they have written net deficit or asset brought forward. So for deficit, they have written it this way, and then if it's an asset, they have used the brackets, right? So this is the opening balance. The open is this balance. You actually take difference between assets and liability. So if the liability exceeds an asset, you write it as positive deficit. If an asset exceeds the liability, you write it as negative like this. Just depends on how you decide. Most people like to put the assets as positive and the liability as negative. Now, what do we do? This is the opening balance. It could be deficit or asset, whatever. Then here you have the net interest component. By the net interest, we usually expect that maybe something has, we assume that the contribution has been paid at the end of the year. So if it has been paid at the end of the year, that means then an interest has already been accrued at this opening balance figure. So you take the interest rate given, you multiply by this figure, by this opening balance, and then actually it would increase it. If it was an asset, it would increase an asset. If it is a net liability, it would also increase a liability. And this interest component goes to the statement of profit always. But also we have something called service cost component. We'll see it later that we can have current service cost and the past service cost. Don't worry about that. But actually, Since it's a service cost, it's a cost that means it increases a liability. And as I told you, the deficit has a positive figure. That's why you have written it as positive. It has no brackets, right? Again, there should be contributions. When you contribute into something, when you make a contribution into the plan, that means you increase assets. So if you increase assets, as you see, your assets had a bracket. So we say contributions into the plan would show a negative sign here. That's just a decision, right? So you have to know that there are matters that would increase liabilities and that would increase assets. So you have to check on the sign, right? And then you could have benefits paid. Now, as you see, benefits paid usually have no impact here. Benefits paid have no impact on the net value. Why? If you pay the benefit, that means you pay the benefits out of the assets, so you reduce the assets. But also, if you pay those benefits, you reduce the liability. So the benefits reduce both assets and liabilities. So if you have netted the amounts, it would look like nothing, right? So if you're preparing the net plan asset or liability, the benefits paid will be of no use right here, okay? Now, after obtaining this figure, you obtain this amount here, this carrying amount, we do the following. No, we do the following, right? You just go and find out the net value. Ignore this remeasurement component, right? Just go and define the net value at the end of the year. If you have the net value at the end of the year, maybe you have the fair value of planned assets and present value of planned liability and have something like this, then you have to compare. You compare this figure and this figure. If there is a gain, you say the remeasurement gain or actual gain. If it's a loss, remeasurement loss. And this goes to the statement of other comprehensive income. It goes to other comprehensive income, right? Yeah. So that's all about this.